Morning, everyone. Thank you for joining us today. Before we dive into today's session, I want to take a moment to highlight an important tool we'll be using throughout the webinar today, and that's Conference.io. This platform is integrated right into Zoom and will be used for submitting polling questions, submitting questions, completing an evaluation at the end, and most importantly, tracking your attendance through CPE credit. If you haven't done so already, you should see a prompt to accept an open Conference.io app in your Zoom window. Please take a moment now to click that, check in, leave the window open alongside your Zoom screen. If you accidentally close the app or don't see it, we'll drop a link into the Conference.io window in the Zoom chat so you can reconnect. Throughout the presentation, we'll be launching polling questions, which, if you are requiring CE credit, you are required to answer using the Conference.io app. Towards the end of the presentation, the app will also offer a link to the session's evaluation. We greatly appreciate you taking time and providing any feedback to us. If you have any trouble, feel free to reach out in the chat. We have members standing by to assist you. Upon completion of the presentation, simply just check out of that app and you should be good to go. With that, presenting today's conference is myself, Kevin Didio. I'm an audit partner. I work with a number of manufacturing clients, and I'll be speaking on the financial statement pitfall side.
And I am Abby Sweers. I'm a senior tax manager, and I'm going to hit a little bit on IRS red flags and a brief overview of the audit process. So to dive right in, so the IRS, everyone knows the IRS, but who gets audited? So we start with random selection. This is just one of every 10,000 returns that gets filed, just gets automatically random selected for audit. So the next one is audits to related parties. So if you have a vendor that you work with frequently, if they're getting audited, the IRS might also look into some of your returns. If you file an amended return, those get kind of put through the microscope a little bit more. So those generally could get audited more frequently. And then tax returns that have red flags. So that's really what we're going to dive in here. And why do the red flags matter? Well, the IRS audits thousands of business returns annually. And these red flags increase the likelihood of an audit or, related penalties and interest assessments. So moving into what we'll cover, just common audit triggers, suspicious deductions on tax returns, and again, a brief overview of navigating the audit process if you do get selected. And who this is going to help, CPAs like us, tax professionals, business owners like you that are filing your own returns potentially, and some of your accounting staff that are just learning the risk indicators when they're going through, your financials, your tax returns, and related documentation. So here's the first polling question, just to get to know the audience a little bit. What's your current role? Are you an owner? Are you maybe a staff, maybe a CPA, other? Kind of just want to get a feel for the room and who we're talking to. So that should get pushed up now on the Conference.io app. You can scan it with your phone. You should be able to answer that. And we'll just wait a little bit while some of the results come in. Looks like they're coming in a bit. Just a few more seconds to see what everyone has to say. And a lot of CPAs in the audience, a lot of staff, some others, so a good mix of people, so that's great. So going in right into types of red flags that you can see on the tax returns. First one is unreported income. So if you're reporting income that's mismatched with your 1099s or third-party reports, so on your business returns, your 1120s, 1120Ss, 1065s or your Schedule Cs for sole proprietors. If the income or deductions that you are claiming on your return differ from maybe a 1099, non-employee compensation or miscellaneous that other businesses have filed with the IRS. If there's mismatch, the IRS may say, hey, whose is right, whose is wrong, could trigger an audit. Bank deposit analysis, so the IRS may come and compare deposits to reported income and flag some discrepancies. So if they see you have $1 million in deposits one year, but you only have 300,000 of gross receipts reported on your tax return, well, now, we have to substantiate what's the rest. Cash heavy businesses, so industries like restaurants, hair salons, car washes are often scrutinized for unreported cash income. So it's very important to keep track of your deposits. How much do you have going on? How many did we deposit this day? Maybe how many car washes did we give this day? So just substantiating all of, the cash moving through your bank account. Second one is excessive deductions or losses. So large expenses related to revenue. If you have deductions that are disproportionately high compared to gross receipts, that could flag some, the IRS. If you only have receipts of $100,000, yet you have $500,000 to travel, how are you substantiating that travel? How is that supporting your business and driving up your receipts? Repeated net losses, so you have multiple years of net losses. It could lead to the IRS questioning whether the activity is a hobby rather than a business. That's where the IRC Section 183 rules come into play. Are you really taking on this venture to make a profit? Or are you kind of just doing it, to fill your time every day? Number 3 is the personal expenses deducted as business expenses. So the first one that they look at is luxury vehicle expenses. Deducting full costs or depreciating the high-end cars could raise questions about personal use. So if you own a manufacturing facility and you buy a brand new Rolls Royce, and you're depreciating that 100% on your books, on your tax return, the IRS may say, hey, what are you using this Rolls Royce for in your manufacturing operations? How are you substantiating being able to depreciate 100% of that? Meals, travel, and entertainment. So these must be ordinary, necessary, and properly substantiated. You can't be just going out to dinner with your family and running these meals expenses through. They need to be real and legit for the business. And then family members on payroll. So paying large salaries to spouses or children without proper roles or documentation. If you're paying your kids $20,000 a year through payroll, but they're not on your website, they're not in your commercials, they're not working for you, they're not doing anything, how are you substantiating, some of those related parties being on your payroll and deducting those salaries? Number 4 is the improper classification of workers. So we could have independent contractors and employees coming into play, misclassifying them to avoid payroll taxes and benefits. So it's really important to kind of take in the context of what is this person doing. If you're hiring an outside machinist to run one job for you, they come in, they do the job, and that's it. That's an independent contractor. You're contracting him to do one job, and you're paying him through a 1099. Whereas if you have a machinist coming in, almost every day, working on very routine runs for you, that's more of an employee, and you have to run him through employee, pay the payroll taxes, offer benefits, things like that. And then missing Form 1099 NEC filings. So these are the non-employee compensation filings. If you're hiring a contractor to come in and do work for you, you have to be issuing them a 1099. There's a line right on the tax return that asks you, do you have any activity that would trigger a 1099 filing? And if you say yes, then it asks you, have you filed those 1099s? If you say, yes, we have activity that would lead us to issue a 1099, but no, we haven't filed them, Well, of course, the IRS is gonna come in and say, well, hey, we want to take a closer look at that, because you need to be filing these 1099s. Number 5 is missing forms and inconsistent filing. So missing required schedules. The big ones are the Schedule M1, which is the reconciliation of book income to tax income. Schedule M2, which is the reconciliation of AAA, which is accumulated adjustments accounts, and OA, which is other adjustment accounts, and the partner's capital. And then the Schedule L, which is your balance sheet. There are exceptions to these. There's certain thresholds. If you meet these, you don't have to file these 3 schedules. However, with all of our clients, we always file these to kind of avoid any question, put any doubt out of mind. And then similarly, if you're not filing Form 1125A to report your cost of goods sold, you have cost of goods sold listed on page 1, but you don't have this supporting form that lists out each itemized deduction on those. Now we're saying we have something, but we don't have support, so they might ask questions. And then along those same lines, the Form 1125E that reports the officer's compensation. Again, we're reporting on Schedule 1 or on page 1 that we're paying officer's compensation and taking the deduction for it, but we don't have the supporting form that lists out each officer. Number 6 is inconsistency across years. So sudden changes in deductions or income without clear justification. And then along with this is the revenue not matching industry trends. So every year the IRS has access to these industry benchmarking data points. And if you see one industry is going up and up and up, but you have one business that's way, way, way down here, they may come in and say, well, everybody else in your industry is doing great. What's going on with you guys? You're such an outlier that we have to come take a closer look. And then non-filing or late filing. So of course, this is gonna, raise questions with the IRS. If you're late or you're missing, any filing, your business income returns, your payroll filings, or you're filing your quarterly payroll reports, or you don't issue a 10 or a W-2 in January, they're gonna say, hey, we know you paid payroll all year. How come you didn't issue a W-2? So these may trigger penalties and further scrutiny. So it's just really important to be consistent, make sure you're filing everything that's required, and not leaving anything on the table that they could come in and ask any questions about. So here's your second point question. Has your business ever been selected for an IRS audit? Yes, no, I'm not sure. It's okay to answer yes. We won't see, who's answering. But just because you've been selected for an audit doesn't mean you necessarily did anything wrong. You could be part of the random selection, or, they could come in because they have a question and you have all the proper documentation to substantiate all the revenue and all the deductions. So don't be afraid to answer yes if that's the answer, that's the truth. And we'll just wait a few more seconds for a few more answers to come in, see where everyone's at. And a lot of no's, so that's perfect. A couple yeses, a couple I'm not sure, but no is what we like to see there, so that's great. And then just a little brief overview of what happens if I do get selected for audit. Don't hit the panic button right away. There's people here to support you if you do get selected. So the process, the audit selection notifications come via mail, always, always, always. The IRS doesn't ever initiate audits via telephone or email or any other method. So if you get a call or an email one day that, hi, I'm an IRS agent, you've been selected for audit. No, you haven't. Don't give them any information. They'll always reach out via mail. And then the actual audit can be conducted through the mail or in an in-person interview. That's more common. In these interviews, they'll either take place at the IRS office or at your place of business. And they will provide you a list of requested documents that they're going to be reviewing. So you would go through that list, gather up all the information that you can, have it available for the agent, when they come on site or you go to them. And that's what they'll be reviewing. And the more documentation that you can provide, the better. And the length of the audit depends on the complexity of the issues and the availability of the information. So if they come in and they say, hey, we're looking at this one specific thing, you provide all the documents that they ask for, everything substantiated, it's typically gonna be pretty quick. If they're coming in and they're looking at this deduction that also impacts this deduction and now this other thing, and maybe you don't have all the information, you have to ask for a third party to provide certain documentation, well, that's gonna drag out the length of the audit process. And then the audit conclusions, so the best one is no change. They come in, they have questions, they review everything, they have no changes. Perfect, all you have to do is, sign their paper and you're good to go. The agreed conclusion is the IRS comes in, they review everything, they propose some changes, and you agree with what they're changing, so you'll have to sign a form, assumably pay the balance due, and then be on your way. And then disagree, so the IRS comes in, they propose changes, you don't think they're right, maybe they're not right. You can request a conference with an IRS manager, or you can simply just file an appeal. It'll go presumably to court, there'll be more questions, it will drag out the length of the audit process. But, you wanna stand on, we don't know this balance due, we disagree with your assessment, and we want a second look at it. So now I'm gonna pass it over to Kevin to go through some financial statement reports.
Thanks, Abby. And I think just to kind of kick it off, it's kind of interesting, Abby touched on it a little bit. But it sounds like the IRS will go and look at your financial statements as well, and kind of some of the things that I'm gonna talk about, they'll be looking for, outliers or things that just don't make sense, and that's how you could get flagged for an IRS audit.
Yeah, definitely. Everything on the tax return, it stems from the financial statement. So when they come in and they're asking for support, the first place you're gonna look is the financial statement.
All right, so keep that in mind. So going through operational and financial red flags, this is more of an accounting piece of the presentation than the tax. So the importance of identifying red flags, detecting financial red flags helps owners and managers mitigate risk and make informed decisions in the operations of the business. Key financial metrics to monitor, metrics that you want to look at would be profitability, inventory levels, cost of goods sold, debt, and efficiency ratios. And then analyze the financial statements along with operations. It is understanding critical. It's critical for effective identifying and addressing red flags. So we're gonna start with inventory. This is kind of directed towards manufacturing. Inventory and cost management is extremely important to manufacturing clients. So that's our starting point. So the first red flag would be excessive inventory levels. Some of the warning signs and indicators would include rising inventory to sales ratio. Your inventory is getting larger, but the revenue is not really increasing, and you could eventually end up with some high obsolete inventory stock. The causes of this would be overproduction or declining demand for your product, or just straight up poor inventory management through the production process. Some of the consequences, again, it could lead to obsolete inventory. I guess not in the manufacturing sense. It's not really spoilage, but maybe stuff that's outdated. And it can really affect your cash flow if you have your cash kind of sitting in your inventory and not being able to use it for anything else. It can further impact your profitability. So what are some of the things that you can do to kind of adjust excessive inventory levels? Well, the first thing you could do is maybe pause some purchasing, right? Wait until you get back online. Some of the other things you could do is align your material purchases and your production schedule with your sales forecast. And now that's something that's a little bit more forward thinking. Again, you can update your sales forecast more frequently. Are you updating it on a quarterly basis? Are you updating it on a monthly basis or a weekly basis? Kind of depends on how fast your inventory is moving as a manufacturer. You can also evaluate how you're monitoring your inventory levels. There's a lot of inventory tracking systems out there that you could use that go all the way from purchase to sale. So maybe reevaluating some of those tracking systems or mechanisms that you're using, the employees that you're talking to on a regular basis, just to ensure your monitoring of inventory levels is accurate with the production. So sticking to inventory and cost management for now. Another warning sign would be unusual changes in cost of goods sold. So sudden unexplained spikes or fluctuations in cost of goods sold accounts is a warning sign here. And we'll look at some of the causes here. So on the material side, it could be increased cost in raw materials from your suppliers that you might not be aware of. On the labor side, it could be inefficiencies in the production schedule. And then for overhead, it could just be a mismanagement of resources. And some of the consequences of that is, a decreased gross margin, and it'll trickle down to your net income will be decreased as well. Adjustments for fixing kind of unusual changes in cost of goods sold. So as it relates to materials, it's important that you evaluate your vendors and your vendor pricing on an ongoing basis, taking a look at those invoices and making sure that the material prices are consistent with the way that you're tracking them in your system. Keep a constant communication with your production staff. It doesn't have to be the people on the line. It can be the managers that are overseeing them, just so you really kind of have a full view of what's going on out in the plant. And also evaluate your production issues. And don't just resolve them, kind of do a cause and effect analysis, right? Why do we have issues in our production schedule? Take a look at that production schedule. What are some of the things we can do to have a more accurate production schedule, so we can align the materials and our labor and our overhead with what we're actually producing. So we're going to jump into a polling question here. Polling question 3, how do you calculate your inventory turnover ratio? So your inventory turnover ratio is a good ratio to monitor on an ongoing basis. This ratio, it'll help you with some of the warning signs that we have just discussed, right? Having unusual spikes in cost of goods sold or too much inventory, right? So A is cost of goods sold divided by average inventory, B, sales divided by AR, C, prior year inventory minus current year inventory, and D, inventory divided by current assets. So the right answer is A, cost of goods sold divided by average inventory. And a really good practice is to take this number and further divide it by 365 days a year. And what that result will be is the number of days that you're turning your inventory over. And a good practice to use that number is compare it to maybe a prior period, or compare it to an industry comparable, maybe a competitor. How are they doing? If you're turning your inventory over in 25 days and they're turning their inventory over in 90 days, well, what's the reason why, right? Are we having better sales? Typically, if it's a competitor, if somebody in the same industry, you would see your inventory turnover ratio be pretty consistent. So you can compare it against industry competitors, but you can also compare it to prior performance or a prior period, or you can set a target for the future. Hey, we want to get our inventory turnover ratio to X, so we have a better cash flow. So moving on to capital expenditures. Again, another very important area for manufacturers, especially if you're trying to grow your business or explore a different product offering for customers. Capital expenditures are a huge commitment. So there are a lot of pitfalls when they come to them. So the first one would be excessive or aggressive capital expenditures. Some of the warning signs there would be high CapEx related to your peers. You also, if you have a committed project and you're seeing a lot of delays, that could be another warning sign. Not necessarily, but could be. Also increasing CapEx without matching revenue growth. So there will be a little bit of a lag, right? You're gonna have your CapEx and then the revenue growth comes after, but it's important to kind of monitor that. Some of the causes to those warning signs would be, misaligned projects or poorly planned investments. Meaning, you made a big commitment to add another manufacturing line, but you didn't line up some of the vendors that needed to come in, or something along that line. So you didn't hire the right company to that had the right specialty to put the manufacturing line in, or you're just not, it just wasn't planned right. Another cause could be poor cash flow budgeting and forecasting. You made a commitment to a project, but you just didn't have the cash flow available to commit to that project, right? What we find is a lot of companies take on some debt in order to take these projects on, it is a good strategy, especially if you do see that growth there and there is a real opportunity there to grow. And some of the consequences here would be project overruns or repairment cost, which essentially will impact your profitability and your cash flow. And if you kind of took on a project that's too much, obviously debt comes with it, so you might be carrying too much debt, which further would impact your cash flow and your profitability. Some of the adjustments you can make here, cash flow budgeting and forecasting, very important process, always thinking about the future, taking the time to really take an analysis of what's going to happen over the next few months, where you're going to be using your cash, where your costs are, how many employees are you paying? That's a very important process as a manufacturer. And then for each CapEx project, really the whole process of making a commitment to that project, right? What are you going to do? You're going to budget, schedule, scope, and then talk to all parties involved before approving it and going further with it. So now moving on to revenue and debt, some of the pitfalls that we see in these two areas. So for revenue, unexplained or inconsistent revenue growth. And again, going back to kind of what Abby was talking about, this is one of the warning signs, one of the pitfalls for the IRS, where they identify like, hey, everybody in the industry is growing significantly and you don't have any revenue growth, or vice versa, right? Where everybody in the industry is going down and you're going up, what's the reasons for that? And there are some kind of warning signs and reasons that aren't acceptable in that reason. And one of those is aggressive or inaccurate accounting practices. You take a look at your revenue recognition practices, and when companies kind of get into a tight spot, they might change their revenue recognition to be a little bit more aggressive. Some of the consequences of that would be inaccurate financial reports, and it wouldn't just be for the current period. I mean, this will impact you going forward. When you make a change like that, it's very difficult to sweep it under the rug without anybody identifying it. I mean, you're eventually going to have to fix it in the future, so you're really just kicking a can down the road. So it's best practice to just keep revenue recognition the way it was, always was, unless you talk to a CPA and there's been a difference from what industry is doing, what you're doing, and that you need to make a change.
I think a big thing to point out there too, and even on the tax side, is it's okay if there is some inconsistencies year over year, but you just need to be able to substantiate that. Someone comes asking a question, exactly, this is why I changed. It's nothing that we did wrong. Maybe we, like you said, switch to something that the industry is doing. So it's okay if you have these changes, but you just need to have the documentation and the substantiation behind that.
Yeah, and it could be as simple as, hey, we have this one product, that we're offering that none of our competitors are offering, and there's a lot of demand for that, right?
Yep, exactly.
So that's just really a simple example of some kind of support that you could provide for anomalies from the industry.
Yep.
So our next topic is long-term debt. So sometimes manufacturers take on too much. Some of the warning signs there would be an increase in debt to equity ratio or declining profitability and cash flow. The causes would be financial and aggressive expansion. So we just talked about CapEx, or an increase in interest expense without an increase in kind of your profitability. And some of the consequences, you'll be a little tight on cash flow, and you might be missing some interest payments, which is kind of alarming. Adjustments, again, as we talked about before, this is a very important process, an ongoing analysis of the cash flow. If you nail that process, you can avoid a lot of these pitfalls in these items that people fall into. And then monitor your debt levels and forecast debt payments. So that's kind of consistent with forecasting your cash flow and your financials going forward. The next topic we have is profitability and cash flow. So profitability, one of the warning signs here is declining gross profit margin. And this is significant or substantial decline in gross profit margin over several periods. Some of the causes would be production inefficiencies, pricing strategy, an increase in sales of lower margin products. So taking a look at your product mix there, your higher profit margin products, you want to make sure that ongoing basis that the volume is consistent, right? And obviously consequences would be lower profitability and less cash flow. Some of the adjustments there, ongoing review of vendor pricing and production cost, and reviewing product mix and evaluate production schedule with your product margins. So moving into another poll question here. Which ratio can be used to evaluate profitability? So you have gross profit margin, which is revenue minus COGS divided by your revenue. B, operating profit margin. That'll be your operating profit divided by revenue. C, net profit margin, which would be your net income divided by revenue. And then D, all of the above. We have 10 seconds here. So evaluating profitability is very important, just like some of your other ratios that we talked about. Profit margin or profitability is kind of your starting point, right? If you're seeing a decrease in profit, you kind of want to work backwards into your financial statements and see what the causes of that is. The correct answer is D, all of the above. So the next point here is cash flow. The warning signs here would be declining cash flow with a continued profitability. Some of the causes would be profits are being driven by non-cash related items. And an example of that would be depreciation. You can also have unsustainable revenue recognition practices that cause declining cash flow or continued profitability. Some of the consequences, right? Lower cash flow for the company's daily operations, paying its debt, and reinvesting in growth. Adjustments could be cash flow budgeting and forecasting. Also monitoring and evaluating profits on an ongoing basis. And also the last one would be to evaluate accounting practices. So that concludes our presentation. If you have any questions, feel free to submit them on Conference.io. As a reminder, please take a moment to complete the session evaluation. Actually, hold on a second. We'll give you a second. If anyone has any questions, we can see them come through on the screen. Not seeing anything yet.
And I think it's just important to, you know, like Kevin mentioned, run these ratios, make sure you're actually looking at your financial statements, looking at your tax returns. Make sure things kind of make sense. You're the one that's working in this business, you're doing the day-to-day, and it's usually pretty easy to be able to open the financial statement and say like, hey, what is all this debt? Like, I thought we paid all this off. Or, why is our revenue down? We did add a new product to the mix that's been really hot. So it's, you know it best. Just make sure you're looking at it. And like we mentioned, if you do have something that might be an outlier, as long as you can substantiate it, that's the most important piece.
Yeah, that's a good point, Abby. So we don't see any questions come through the conference IO. If you have questions that come up later, feel free to reach out to Abby or myself. And as a reminder, please take a moment to complete the session evaluation. Your feedback is greatly appreciated. Once complete, you can just simply close out of the app. So thank you for your time today.
Yep, thank you. Appreciate it.